Welcome to The Explainer. Okay, today we're unpacking what is honestly a fascinating puzzle in the financial markets. We're looking at Neogen Corporation, which is a massive player in global food and animal safety. And their latest Q3 2026 earnings report, well, it's what I like to call a turnaround paradox. It's packed with these really positive headline beats that sent the stock moving. But when you actually look under the hood, those headlines are colliding with some incredibly challenging underlying data. So we're going to break down exactly what management is doing to try and steer this massive ship in a totally new direction. Here's our roadmap so we can systematically unpack this. We'll cover 1. The Neogen earnings paradox, 2. Inside the core business, 3. Headwinds in animal safety, 4. The strategic transformation plan, 5. Financial health and leverage, and finally, 6. The long-term outlook. Let's get right into it.
All right, section 1, the Neogen earnings paradox. So we're kicking things off with the really conflicting signals the market is wrestling with right now regarding their Q3 2026 results. Because if you only read the headlines, you'd get a vastly different picture than if you sat down and read the actual income statement.
This right here brilliantly illustrates the tension. On the one hand, they absolutely crushed earnings per share expectations. I mean, they posted 9 cents against a 4-cent estimate, and they even raised their forward guidance. But simultaneously, their actual overall revenue shrank by 4.4% year over year, dropping down to $211.2 million. And even more alarming, especially if you're a traditional value investor, their trailing 12-month net profit margin is sitting at a negative 69.9%. So they're beating the street, sure, but the core engine itself is contracting. And what makes this tension truly staggering, like literally jaw-dropping, is this number. A price-to-earnings ratio of 865 times. Just let that sink in for a second. For a company seeing its revenue contract, the market is pricing in an absolutely massive expectation of future growth and margin expansion. Investors aren't paying for what Neogen is today. No, they are paying a very steep premium for what management promises it's going to become tomorrow. Section 2, inside the core business. Now, to understand how on earth they plan to justify that valuation, we need to step back and look at what Neogen actually does out in the real world. Because behind all the spreadsheets and financial engineering, their core mission is absolutely critical to everyday life. They provide the diagnostic tests, the culture media, and the biosecurity solutions that are necessary to make sure the food on our tables is actually safe and that global livestock populations stay healthy. So the crucial point to remember here is that their revenue engine is basically split into 2 distinct halves: food safety and animal safety. And the whole reason this quarter's earnings look so weird is because these 2 halves are performing very, very differently right now. While food safety is showing some decent resilience and growth, that other half, it's dragging the anchor. Moving to section 3, headwinds in animal safety. Let's look at the problem child of this Q3 earnings report, because this is exactly where that revenue contraction is really being felt. This segment has really severely pressured their profitability. You see, U.S. production animal herd sizes, they are sitting near record lows right now, and fewer animals simply means less demand for veterinary products and safety tests. Combine that with some friction they're having in their third-party distribution networks, and it has just been a heavy, heavy drag on operating margins. But there is a silver lining. USDA projections are actually hinting that herd sizes might be nearing a cyclical bottom, which means the market itself could naturally rebound as ranchers start reinvesting to meet global protein demand. Which brings us to section 4, the strategic transformation plan. With these headwinds super clear, let's examine management's actual prescription for a turnaround, because they aren't just sitting around waiting for herd sizes to magically bounce back. I absolutely love this quote. It shows direct executive accountability and honestly a willingness to completely rethink how they do things. CEO Mikhail Nassif, who's drawing on his past turnaround success over at Siemens, is essentially saying, look, if it costs us too much to sell directly in a slow-growth region, we're just going to hand it off to a partner, save the cash, and redirect those funds to high-growth areas. It's practical. But hey, distribution isn't their only problem. Look at this number. This is a massive red flag, 56%. That is the percentage of their operating expenses tied up purely in salaries and benefits. And as management openly admitted on the earnings call, this points to a massive historical underinvestment in process automation and modern tech. Basically, they've been throwing human labor at problems that software really should be solving. So how do they fix a bloated structure? Well, it's a systematic, step-by-step rollout. First, a really rigorous review of what they are actually spending money on. Second, actively rolling out AI and new tech across customer service, finance, and R&D to finally replace those manual processes. And third, optimizing their go-to-market strategy by leaning heavily on distributors where it makes financial sense. And this builds perfectly into their whole portfolio rationalization strategy. They recently decided to just slice off their genomics business. Why? Well, it was operating with mid-teens margins, which is way below the corporate average. Selling this off immediately improves overall operating margins and sheds a whole layer of corporate overhead. It makes their earnings immediately accretive, meaning it instantly boosts their bottom line value. It's a classic textbook case of addition by subtraction. All right, Section 5, financial health and leverage. Because big transformation plans are great on paper, but we need a reality check. Let's ground all this ambition by looking at Neogen's balance sheet to see if they can actually afford to pull this off. Take a close look at how their debt has trended over the last couple of years. It's a steep climb. Their debt-to-equity ratio leaped from historic lows of around 0.12 in early 2022, spiked in late 2022, and has steadily climbed all the way up to 0.60 today. They are carrying significantly more leverage right now, over $1.2 billion in long-term debt, than they ever have historically. But, it's not all doom and gloom here. They actually maintain really strong short-term liquidity. Their current ratio is 3.9x, meaning they can easily cover their immediate obligations. And more importantly, management has explicitly targeted reducing that net leverage to under 2x. They know the debt is heavy right now, and cleaning up that balance sheet is a core pillar of this whole turnaround. Finally, Section 6, the long-term outlook. Let's wrap up this analysis by looking at the finish line. What does this company look like if management actually pulls off this multi-layered transformation? Because despite all the turbulence in the animal safety side and these massive operational shifts going on, they actually raised their full-year guidance. Yeah, they are now projecting up to $855 million in total revenue and about $175 million in adjusted EBITDA for fiscal 2026. This near-term confidence is exactly what helped drive the stock price up after the earnings dropped. And if we look further out, assuming this turnaround plan actually works, this is the ultimate prize they're chasing. They call them their best-in-class targets. They're aiming for a massive 30% adjusted EBITDA margin, 100% free cash flow conversion, and steady mid-single-digit core revenue growth. Basically, they want to turn into a highly predictable, high-margin cash machine. So, I'm leaving you with this to ponder. The strategy, dropping low-margin stuff, automating labor, leaning on distributors, it's incredibly sound on paper. But with the market pricing them at 865 times earnings, the margin for error is basically zero. Flawless execution is quite literally the only option if Neogen wants to justify this turnaround paradox. Thanks so much for joining me on this explainer. I'll see you on the next one.